All right, we are doing the practice of IAS-12. And first of all, we have question 115 from your Kaplan kit. And the requirement is, what is the income tax expense that will be shown in the statement of profit or loss for the year? Now we have done the IAS-12 and we know each and everything of it, that when we are being required to calculate the extracts of the statement of profit or loss, so we are going to first of all see the current year tax provision, and then we are going to see whether there's under or over provision. So it says income tax payable for the year. That means it's the income tax expense for the year, which is the current year tax provision. It's 60,000. Then we have the over provision, and we know that the over provision reduces the tax charge. So you are going to deduct the over provision less 4,500. And then we are supposed to see whether there is an increase or decrease in the deferred tax liability. So how we can calculate it, I've already told you, you just need to compare the opening with the closing. So opening is 2,600, closing is 3,200. So we clearly have the increase in deferred tax liability, and that increase in deferred tax liability is recorded as an expense. So increase in the deferred tax liability, which is 600, and now we get the result. This is the expense which should be recorded in the statement of profit or loss. So how much it is? We have 60,000 minus 4,500, which is the over provision, because over provision reduces the tax charge. And then we have the 600 increase in deferred tax liability, which should be recorded as an expense. It is 56,100 expense in the statement of profit or loss. So the option is D. What is the current liability? In this question, we are not supposed to tell, but I'm telling you for the other questions. If they ask you regarding the current liability, so the current year tax provision is your current liability. If they ask you regarding the non-current liability, so the closing deferred tax liability is your non-current liability. Okay, now we have another question, which is question number 116. And again, let's read the requirement first. What figures will be shown in the statement of profit or loss for the year ended 30th September 20x1 and the statement of financial position as at that date in respect of the income tax? So the year end is 30th September 20x1. So I've already told you that the current year tax provision is your current liability, which should be recorded within the statement of financial position. So let's see. Estimated income tax for the year ended 30th September 20x0. This is the previous year because we are being asked for the 30th September 20x1, but there's a logic why this is being given. Income tax paid for the year ended 30th September. That means the actual tax of 20x0 was 80,000. The estimated that you recorded were 75,000. What you paid was 80,000. So that means the estimated was less than the actual, and this give rise to the under provision. Because the tax you provided in 20x0 was 75,000, this was your estimate, but the actual tax was 80,000. So this clearly says that you recorded less tax of 5,000, which is the under provision. And then we have the estimated income tax for the year ended 30th September 20x1. This is the current year tax provision, which should be recorded as the current liability. So you put it over here in the current liability as 83,000. And then you need to calculate the extracts of the statement of profit or loss. We already know that how to do. So first of all, we need to take current year tax provision. So current year tax provision, which is 83,000. And then we have the under provision, and we know under provision increases the current year tax charge because you provided less in the previous year, which is 5,000. This will increase your current tax charge, and the statement of profit or loss expense for the year is 88,000. So 88,000 will be put over here. 83,000 will be put over here. Okay, now we have question number 117. Hudson has the following balances included on its trial balance at 30th June 20X4. Taxation, we have 4,000 credit. Deferred taxation, we have 12,000 credit. Now, in the taxation, when we have the credit balance, we know it's an over provision, even if it is not written. But obviously, this is a good thing that the examiner has mentioned that this is an over provision. But even if they didn't mention, we know that if the trial balance contains a taxation balance, just the taxation, not the deferred taxation, just the taxation, and it's on the debit side, we know it's an under provision. If it's on the credit side, we know it's an over provision. Now, the over provision decreases the current year tax charge. Okay, what is the current year tax charge? The year end is 30 June 20X4. And they're asking us again to prepare the extracts of the statement of profit and loss. So at 30th June 20X4, the directors estimate that the provision necessary for taxation on the current year profit is 15,000. So that's an easy thing. It's a piece of cake as long as you know the format. So current year tax provision. So current year tax provision is 15,000, and we know this is the current liability. Anyways, we're not supposed to tell the current liability, but just for your information. Okay, then we have the over provision. Okay, we know the over provision reduces the current year tax charge, so you're going to deduct 4,000 over here. Then it says the carrying amount of the Hudson non-current assets exceeds the tax written down value by 30,000. I told you that in some question like the previous ones, you will see the opening and the closing balance of the deferred taxation. But in this question, we have the opening balance of 12,000, but the closing is not given. And I told you when we were doing the standard, when the closing deferred tax is not given, the examiner will give you the temporary difference. So you see, the carrying amount, the carrying value exceeds, which means more than the tax base. So we know when the carrying value is more than the tax base, this gives you the taxable temporary difference. And the taxable temporary difference in this question is 30,000. When you multiply it by the tax rate, which is 30%, you get the closing deferred tax liability, which is 9,000. So opening balance of the deferred tax is 12,000. Closing balance of the deferred tax liability, which is calculated by multiplying the taxable temporary difference with the tax rate, is 9,000. So there is a decrease in the deferred tax liability, and decrease in the deferred tax liability is the reduction in the expenses, or you can say income. So we are going to deduct 3,000 from it. All right, so 15,000 minus 4,000, 11,000 minus 8,000 minus 3,000 gives you 8,000. This is the expense that should be recorded within the statement of profit or loss. So remember, IAS-12 is a piece of cake as long as you understand the format and the relevant figures, how to play with it. That's it, nothing else. Okay, now we have question number 118. Holmes has the following balances included on its trial balance at 30th June 20X4. Taxation 7,000 credit, and we know again it's an over provision. And the deferred taxation of 16,000. This is the opening balance of the deferred tax liability. How I figured out that this is a deferred tax liability, because this is on the credit side. If it was on the debit side, then this was deferred tax asset. because it's on the credit side, it's a deferred tax liability. At 30th June 20X4, the directors estimate that the provision necessary for taxation on current year profit is 12,000. The balance on the deferred tax account needs to be increased to 23,000. That is the closing deferred tax liability, because it says the balance on the deferred tax account needs to be increased. This is the closing balance, which includes the impact of the increase in the property valuation below. That means this includes the deferred tax on revaluation. During the year, Homes revalued its property for the first time, resulting in a gain of 10,000. The tax rate is 30%. We know that the gain on the revaluation is recorded in the other comprehensive income. So does its deferred tax consequence. And we know that the revaluation gives rise to the deferred tax liability because the carrying value is increased and the tax base is static because the taxation authority does not accept the revaluation. So how we are going to do it? First of all, we need to see statement of profit or loss. Okay, the extract, because they're asking us to calculate the figure for the statement of profit or loss. We have the current year tax provision. Again, the same thing to do. Current year tax provision. That's a quite simple thing to see within the question. It says at 30 June, the directors estimate that the provision is 12,000. So it's 12,000 right here. An over provision reduces the current year tax charge. So simply deduct it, 7,000. Now we need to see whether there is an increase or decrease in the deferred tax liability. So we know the format of it. First of all, see what is the closing deferred tax liability. The closing deferred tax liability is 23,000. This includes the deferred tax on revaluation. So you need to deduct it. Deferred tax on revaluation. How much it is? 10,000 is the gain. Multiply by 30%. So that means the gain on the deferred tax is 3,000. Deduct it because it includes deferred tax on revaluation. So you get the 20,000 net figure. Now compare it with the opening balance. Now compare it with the opening balance. The opening balance of the deferred tax liability is 16,000. So we see there is an increase in the deferred tax liability of 4,000. So increase in deferred tax liability recorded as an expense of 4,000. So you get the figure which goes to the statement of profit or loss. 12,000 plus 4,000, 16,000 minus 7,000 gives you 9,000. So 9,000 is the figure that should be reported in the profit or loss. This closing deferred tax liability, which is 23,000, is your non-current liability. And this current year tax provision of 12,000 is your current liability. So this is how you are supposed to do the deferred tax questions in the exam, both in the objective test case questions and the final account question.